My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends, just trying to make you some money. My job is not just to entertain you, but to educate and teach. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Talk about a market that has no memory. Yesterday, it plummeted, ostensibly because we've lost control of COVID-19. Sell. Today, it roared higher. Buy. With the Dow poll voting 400 points, S&P gaining 1.36%, Nasdaq advancing 1.02%, led by the companies that stand to benefit the most from the end of the pandemic: hospitality, travel, and leisure. Has the market lost its mind? No. We're dealing with cross currents. Anytime stocks get hammered, it seems to trigger a visceral vaccine reaction, where good news bails us out. On the one hand, we know the cavalry is indeed coming, and it's going to be in the form at least of one Pfizer's vaccine. On the other hand, it won't reach us in quantity, perhaps until the spring. And in the meantime, the virus is out of control in the country. We had 163,000 new cases yesterday. We're in for a rough winter, yet in the last 24 hours, we've gotten some sharply better than expected results. Earnings from Cisco, the networking titan, from Applied Materials, the top semiconductor equipment maker, from Walt Disney, which needs no introduction. On top of that, it's looking increasingly like we'll have a smooth transition from the Trump administration to the Biden administration, albeit not a particularly gracious one. That's a huge change, though, from even last week at this time, because it took off the table the notion of Trump refusing to make plans to vacate the White House. Now, I'm sure you're sick of hearing it, but the market loves certainty, and there's nothing less certain than a contested election. Could the good earnings continue? If you're more worried about the virus than encouraged by the vaccine, next week will be pivotal for you, because we hear from some major national retailers, and I think they'll have a surprisingly positive story to tell. So Monday starts off with something a little different. The results from Palo Alto Networks, okay? That's that giant cybersecurity company. CEO Nikesh Arora has put together a terrific set of assets for an economy where millions of people are staying or stuck at home working. I expect very strong numbers. Then we hear from one of the most controversial names in the entire S&P 500. We hear from Tyson Foods. The meat processor had a major COVID problem that now seems to be behind them, thank heavens. But the stock is stalled here. I used to believe that Tyson stock would benefit from improved relations with China because they need American pork. But now I feel like nothing will help Tyson aside from sharply better than expected earnings. And they haven't been able to deliver on that for a long time. Could this time be different? If they do, I've got to tell you, the $62 stock is going to go up a great deal. Tuesday's gigantic. Walmart, Home Depot, Kohl's. I bet Walmart's going to dazzle. It's where you go to get anything in a pandemic that, for whatever reason, you don't want to get from Amazon. My Travel Trust, which you can follow along by joining the ActionAlertsPlus.com club, has been buying the stock aggressively. Home Depot is the best do-it-yourself renovation play at a time when people are busy turning their homes into offices or schools. Both should report spectacular earnings. Anything less than spectacular, though, and these stocks will get hurt. Kohl's is a lot more problematic. The stock's been showing some signs of life lately. The quarter is very important to the broader market because Kohl's is not an essential retailer, which makes it a good gauge of whether consumers are willing to venture out for non-essentials. After the close, we hear from NIO. Oh, NIO. Oh, my. The Chinese Tesla, right? That's what they call it. Stock that's up 1,200% in the last 6 months. Yeah, you heard me right. This electric vehicle maker has become the belle of the ball, even as it pulled back today when a big-name short seller came after it. The thing is, NIO's still losing tons of money. Then again, until pretty recently, so did Tesla. I think people will keep buying this stock as NIO continues to ramp production, because if it is the next Tesla, that means you don't need to care about the short term. For the moment, it's more of a concept than a company. Long term, though, they have to deliver. If anyone says, Jim told me to buy NIO at 47 and I got hurt, you just didn't listen to what I have to say. Wednesday, things get confusing because some of these stocks will have already reacted to the companies that report on Tuesday. So in other words, this one, if these are X, then these will be 2X. We get results from Target, which has become America's favorite fun store to go with, again, with a terrific e-commerce kicker, by the way, shipped. But the expectations have gotten incredibly high and will even get higher if Walmart's good, okay? That makes it hard to beat. Then there's Lowe's, where CEO Marvin Ellison is doing his best to turn around the operation. Still has some issues, although it's being buoyed by the pandemic. COVID has caused an exodus from the cities to the suburbs and the country, because if you're going to be stuck at home, well, you might as well have some outdoor space. Even if Lowe's were poorly run, it would be a great moment for them, but it's not. And Ellison is striving for excellence, to be the best of the best. Lowe's isn't quite there yet, but the numbers should be so strong that you won't even notice. How about TJX? Parent of TJ Maxx, Marshalls. We sold this off-price chain for my charitable trust, mostly sold it here to buy that one. Why did we do this? Well, it's simple. We wanted to take advantage of the rally this week, take some profits. Why? Well, because COVID could be a great long-term opportunity for these guys. TJX buys up excess inventory from struggling retailers. But short-term, I don't see them bringing in many customers because they don't carry anything you can't live without. And that's a recipe for perhaps a disappointing quarter. So some of we took a loss on, but most of them took a gain. Now, okay, here's one that I'm closely linked with, and I'm proud of being linked with. It's Nvidia. Nvidia reports after the close, and I, for one, am glad this stock's been coming down this week, because that makes it easier for the stock to blast off in response to a fantastic quarter, which is exactly what I expect. Now, Nvidia is trying to buy ARM Holdings. It's a deal that would make this company the undisputed king of the semiconductor space. They might get some pushback from the regulators, but in the end, I think the deal will be allowed to go through. That said, I think it puts a lid on the stock. And just so everybody understands, this is the kind of stock that's being sold here as people circle back into companies that do better if the economy opens. Just be aware, there's nothing wrong with Nvidia. There's just some people don't like the valuation of the stock. Thursday, we hear from Macy's, which has been bouncing between 6 and 8 for months. Can it finally break out? I don't know. A lot of it depends on tourism because of the flagship store, Herald Square. Now, anything that's levered to the New York tourism scene is in trouble. So I don't know if we're going to get a breakout here. The company's done a lot to turn itself around, but Jeff Gant's doing a good job. But you know what? In this environment, it may not work. Workday reports after the close. Now we're back, and you've got you have tech. You have tech, and you have tech, okay? Now, Workday is the cloud computing company that does so much to automate a lot of back-office stuff. And now, these have been ordinarily terrible, terrific, terrible, terrific. It's awfully hard to know which way it'll be that day that Workday reports. And this is one of the toughest to gauge. Why? Because the software that they use to automate human resources and finance is a little opaque for most Americans to understand the stock. Companies winning contract after contract, but people don't understand it. I think it's a really well-run company. Friday, we get a read on the mall thanks to Foot Locker, like that. These mall retailers have mostly been written off for dead, and some of them are actually not so bad, though. Could Foot Locker, could they post a good quarter? If only because we know that Nike and Under Armour are moving a ton of merchandise? It's possible. You know what, though? Nike sells a lot direct to consumer. I'd rather just have you in Nike. Now, I regard next week as the official conclusion of earnings season, thank heaven, so it might be helpful to reflect back for a second. There have been a huge number of beats this quarter, far more than anybody thought there would be. It's one of the best we've seen in ages. Maybe that's because the expectations were ratcheted down too much. Maybe it's because the pandemic has wiped out tons of small competitors, leaving big publicly traded companies as the last men standing. Either way, here's your bottom line. If you find yourself wondering why stocks can keep roaring when we've got an insane number of COVID infections, the answer is simple. To paraphrase James Carville, it's the earnings, stupid. Big business is making a ton of money right now. Frankly, it's not all that complicated. Our Salute to Service Veterans Day tribute continues. Our first question is from Roger in Texas. Roger.
Hey, Jimmy Chill, big hoorah, booyah, coming at you from Houston, Texas. Just want to say thank you for everything you do for us. I was in the Marine Corps for 5 years, serving different places and parts of the world, and it was always great having you provide a sense of normalcy in an otherwise abnormal time and place, so thanks for that. Question for you, Jim. It looks like the Democrats are going to control the House and the White House. The Republicans are going to maintain control of the Senate. So what does that mean for us retail investors in that split government? Is it growth, value, energy, FANG, or maybe something else even? All right, thanks again, Jim.
Wow. Thank you for being such a devotee, and thank you for your service in the Marine Corps. I think we're going to have to deal with new categories. I don't think growth and value are going to work anymore. I think there are companies that are going to do well in a market where we need the vaccine, and there's going to be companies that do well in a market where we don't get the vaccine, and we're just going to have to take them case by case. The labels are failing us. And that's something that a lot of people don't understand. The labels are failing us. Okay, let's go to Justin in New York. Justin.
Booyah, Jim. Thanks for having me on the show. I just want to give a shout out to Jonathan, Dan, Tyler, David, Simon, and Aaron, and go Eagles. My question is about Gilead. I bought it at 80 at the height of the pandemic because of its drug and remdesivir. Since then, it's pulled back to 50 and now is on 60. Do you suggest I buy more, sell, or do you think it has the potential to go back to where it was before?
I remember we don't care where stocks have been from. We care where they're going to. I think this one's bottoming because of interest rates. But when it gets back to, say, 64.5, please sell it and go into something growth. You know what? You can swap it one for one with Bristol Myers. I think that'll work. That worked perfectly. Next question is from Matthew at the U.S. Military Academy at West Point. Matthew.
Hey, Jim, it's Cadet Matthew Jordan from Massachusetts, and I'm a first year here at West Point. I'm a part of the investment club, and currently I lead the finance sector. Recently, my team and I have been researching JP Morgan. They took a 71% stake in a Chinese security joint venture. Does this put them at a competitive advantage, and are they a buy? Thank you.
All right. Thank you for your service, too. And I love the Academy. Here's my problem with J.P. Morgan. Interest rates are so low, they can't make any money on your money. And that's how I like a bank to make money, because it's riskless and pain-free. I think the stock is not a buy. As a matter of fact, I would actually lighten up and own something more like a Goldman Sachs or a Morgan Stanley. Next, we have a question from Harold in Texas. Harold.
Hey, Jim, this is Tim from Dallas, Texas. And I served in the United States Army for 32 years. It was a great life being in the military. I'm looking for your advice in decision-making for a great investment to continue that life. What military defense companies would you recommend for this old bull? I need to go from hoorah to booyah!
Well, there, I like that transition. James Takelet runs Jim now, Lockheed Martin. LMT is very good. I have to tell you that I am partial to Bill Brown and LHX, which is L3 Harris. Those are the two that I would recommend. I think that they are the right ones for a Biden administration. All right. Remember, it's the earnings. Thank you so much for your questions and for your service. It's the reason we're going higher for a number of reasons, but in the end, the companies are doing very, very well. Big business is making lots of money. On Mad Money tonight, I'm sitting down with the Home Depot of Weed, Grow Generation, to find out how the company's positioning itself in more states legalize marijuana. Every time they look up for vote, it wins. Then, what could the U.S. election outcome and news of a promising coronavirus vaccine for your money? I'm going off the charts and eyeing the market's fear gauge to find out. It'll help us figure out about the industrials, believe me. And more small businesses are getting back to work. But with stimulus questions still lingering, what does it mean for a company like Bill.com, which has been so red hot? I'm going to talk with the CEO after earnings. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.